Debt universe was a it was a backwater, for lack of a better word. You had very specialized players, usually small hedge fund type structures. Some of the big investment banks had trading desks that specialized in this. The desk that I joined at Merrill Lynch first back in 2002, that was the focus of ours. Really, it was in the distressed debt space, but we were part of our overall credit franchise, if you will. And it was really guys who had legal expertise in terms of looking at lender agreements. They had expertise looking at operations of companies and evaluating operations of companies, whether there was asset value in a distressed company or not. Some players specialized in real estate. So there were a variety of guys who really kind of came to market. Some of the big names in the market, you'll recognize, right? Apollo was one of the early movers there, Oaktree, etc. So Lone Star, for example, has been in and out of the distressed market. There's been a lot of guys that have a lot of track record. A lot of those big institutions, Apollo, Blackstone, etc., they've grown into be huge diversified credit managers now, rather than specialists in distressed debt. In today's market, I think you'll find that the specialists that play in that space tend to be smaller. Right. I think the funds are generally smaller. The workload is generally smaller. Finding opportunities is definitely a smaller market. Deploying money into the private credit direct lending market, you can deploy billions a quarter. Deploying money into the distressed debt market, it's much smaller of an opportunity. A fraction of it, a quarter, a tenth, whatever it might be. So it's really evolved. A lot of the big asset managers, they do have groups within them that specialize in distressed debt or special situations. A lot of those big institutions, they've had mixed results in terms of that part of their investing business. The reason for that are numerous. Sometimes those businesses are restricted from doing certain things based on the franchise that they're within. Investment groups within big banks, for example, have conflicts of interests with the rest of the bank, with their banking clients, with their financial institution clients and things like that. So they're not always able to go after the biggest and best opportunities out there. Some credit managers that have started outside the distressed space or the special sit space and moved into the distressed space have sometimes found it difficult because they don't necessarily have the right expertise. And they try to manage those assets with more performing credit teams, and they don't necessarily look at things the same way. So there's a lot of different players, and some guys move in and out of the market, but it's generally the smaller players, I think, that dominate now.